Hi,
Awesome.
everybody. Ryan Sheppard. I'm a partner with Rolleri Sheppard CPAs here in Fairfield, Connecticut, back for another video on tax and other matters. Today, I have a special guest, Zahya Beall, a financial advisor and asset manager with Moneco Advisors here also in Fairfield. And today, we're going to talk a little bit about year-end moves, both related to the financial market and also the tax management side of things. So Zahya, just want to give you a chance to introduce yourself.
So great to be on here today. Thanks for the opportunity, Ryan, to be a part of the discussion with Moneco Advisors here in Fairfield. And I've been in the investment and insurance business for 20 years. So looking forward to the conversation and offering some perspective.
So you're new to this. Well, that's great. And Zahya, it's been a pleasure working with you, and appreciate the back and forth that we have on related to mutual clients. As we get closer to year end, Zahya, one of the things that I think we both hear about from our mutual clients is what should I be doing at year end with regard to taxes and also asset management, financial advice, that kind of thing, what's going on in the market. So today, I think it's an important topic to talk about as we get closer to the end of the year. What's going on? What should people be thinking about? And that's why we're talking here today. One of the things I hear a lot is, clients will call and they'll ask about tax loss harvesting. And my first question is, do you know what that means? First of all, and you think of harvesting, it's you think of farming, like where I'm from Indiana. You think of farming and pulling up the crops and harvesting them. What they're talking about and what that term means is taking some of your unrealized losses, as you know, and actually selling that security so you can then generate the loss for tax purposes. That loss can then be used to offset your other capital gains, not to exceed a $3,000 loss in total. So for instance, let's say I have $10,000 in gains from the beginning of the year. And now no one really has gains at the end of this year, but people at the beginning of the year may have had some realized gains. So now we get to the end of the year and they have $20,000 in say unrealized losses. Now, again, that means losses in the portfolio that haven't been realized yet because the stock hasn't been sold. So if the client sells the 20,000 in unrealized losses, that will offset the 10. I have 10 left over. And then I'll be able to use 3 of that, and the other 7 will be able to roll over. Does that make sense?
Absolutely. That's definitely a key part of the strategy for us.
And so as you're thinking about it, let me just toss it over to you for a second. When clients ask me the question, it's, my angle is obviously more of a tax angle, but when you're talking to a client, what conversations are you having surrounding that? Because you may like the stock or they may like the stock. What kind of things are you guys talking about?
Yeah, I think ultimately it makes a lot of sense. The silver lining is to book the losses on paper. But if we really like the exposure or the position, what we'll oftentimes do is look for something that's very much sort of a mimic strategy of what they own. If it's a stock, we may go into a broad ETF for the 31 days that we need to sit outside of that stock position in order to realize the loss. And then we'll go back in. And so ultimately, we want to most often keep the same exposure. And there's a lot of ways to do that because there's so many different options in the investment universe. But we want to make sure we're staying invested while we still get that silver lining of taking the loss to reduce taxes.
Let's talk about that 31 days that you mentioned, because that's really a tax concept. And I think you make a good point. If you sell something at a loss, just so anyone listening understands the rules, if you sell something at a loss and you buy it back within 30 days, you basically can't take the loss for tax purposes under what's called wash sale rules. And so that's what Zahya is referring to there. But that's a great point, because that's something I think a lot of times not a lot of folks don't think about. They think, well, I'm going to sell the stock, get the loss, and I'll buy it right back. Well, it's not that easy. You got to wait 30 days and then you can buy it back in order to get the loss.
Yeah. And I think that's where also the technology becomes really important. And a big part of Moneco, of why I joined the firm, is the technology that's here. So we have really efficient ways to find where there's tax loss harvesting opportunities, and then how we can set up reminders when those 31 days come to switch back into the original holding that we want to be into. So we very much have a way of automating it. There's humans behind it, but we use our systems to help us stay on track so that everyone can get the best out of this, every single client on the book.
And that's a great point. Now, along those ends, as you're having these conversations, what are some things that you're seeing at year end that clients are most interested in, or from a market standpoint, what are you seeing as you get closer to year end?
Yeah, I think overall we're taking a moment to add perspective on what took place last year, because 2022 was truly an extraordinary year in the market. And I say extraordinary kind of in the way that your doctor gives you results from your test results, which also doesn't always mean that it was positive. But I think it's really important to offer perspective that clients understand this was an extraordinary year, specifically in the bond and fixed income market. So we spend a little bit of time putting a context around that so that they know that this is not something that they should expect year after year. Truly, if you looked at the traditional 60-40, 60% stock, 40% bond portfolio, there's only been 15 years since 1940 that they've been down in negative more than 10%. So you really should expect this to be a protected portfolio. And we also know from history that in those 15 times, the next year after that is an average of 18% up return.
So that's interesting. So is that every time, like that's been the average of those, after those 15 years of those losses, the next year tends to have that much of an increase?
Correct. And that is the average. Of course, I have to mention that past performance is no indication of future,
Right.
But we're really trying to help clients refocus on the next year and going forward, and not letting this year derail them from the perspective that this is not a normal year. It really was an extraordinary year.
Yeah, that's a great point. I think I would also add that in some years, depending on what's going on with tax rates in one year to another, that often will dictate what we do from a, what a client does from a year-end standpoint, from selling or buying or triggering gains or not triggering gains. If I know I have a lower income tax year next year, I may postpone some gains, but this is one of those years, this year and next year, where we effectively have a status quo in the tax code. And now for taxpayers, that's a positive, because you effectively aren't going to have any changes, most likely, at least material ones, over the next 2 years. And that's because we now have a split Congress. So when you're talking about capital gain rates and dividend rates, interest rates, anything on the investment side, those are likely to be very, very safe and consistent over the next 2.5 years at this point, at least until the next presidential election kicks in.
Sure. And a big piece of that, Ryan, that I think is important to both of us is then also looking at the opportunity to tax diversify with things like Roth conversions, where your account is down artificially. It's a good opportunity to make the move, have a little bit lower tax impact, to move some of that money over into an after-tax, hopefully never pay taxes again bucket. And so that's something I think is really important. And I think one of the advantages is making sure your advisor is talking to your CPA and strategizing for you, which of course you and I do for our clients. So that's a big piece of what we're looking at as well this year.
Yeah, I've had that situation this year too, and we've taken some advantage of that, where we're rolling over those IRAs and doing Roth conversions in cases where client may have a down year this year and it's going to kind of go back to normal next year. So, let's say they're in they're in the 12% bracket this year, and next year they're going to be back up to 37. Well, it's a great year to do some conversions in that case. Obviously, consult your advisor and consult your CPA before you do it, but that's generally a great year to take advantage of that. So that's a good point. Any common perception that you see at year end that people need to think about as they enter the close?
Well, one of the things that I think is somewhat of maybe a misstep in how we evaluate moving forward. And what I mean by that is the investment community in total is in my 20 years working in the business, I spent half of that on the other side in the investment space, working for a large asset manager. And I noticed oftentimes people look at calendar year returns. So January 1 to December 31st. Ultimately, that is a very arbitrary number to work off of, and it doesn't really tell you a lot about what took place. So if I were an investor evaluating what I own and what I might want to own in the future, I would really seek out information through the various tools, the websites for the funds, and looking at stocks on a longer term basis first, 5 and 10 year if you have it, but also looking for what's called rolling returns. And the idea here is that you're looking at how a fund may have done January of this year to January of the next, February of the last year to February of the next, March, and so on and so forth. And what that does is it removes a lot of the idiosyncrasies that can really sort of alter the way that you're looking at these and get a much better picture on how do they actually really perform in a full market cycle against the other folks in their category.
It's really interesting. So I think the takeaway from all of this is that there are so much intertwined aspects of what we do from a tax standpoint, and then from an investment management standpoint, that they almost have to be working in tandem together as a client sort of moves through their financial life cycle. And doing one without the other is sort of like, rowing a boat with one oar. It doesn't totally work because you want to maximize both. So I think the takeaway for me is that anyone looking to do anything at year end, be sure to consult both your financial advisor and your CPA as you're making these moves, just to make sure you sort of have everything covered. Is that a fair statement?
Yeah, I think one last comment I'll make on that is, not to promote any particular fund, but Vanguard does have a white paper that's out there for clients. And it says that working with your CPA and advisor can drive 3% additional returns year over year. And only 1% of that is from investments. The other 2 is from tax planning and wealth planning. So I definitely agree with you on that front. And that's a big driver for how we can make money and save money for clients.
That's interesting. Well, Zahya, I appreciate your time today. This was really helpful, and hopefully we gave some good information to folks who need it.
Thanks, Ryan, again for having me today.